What if we retired at 65 instead
What
of
if one of us
67?
needs long-term care in our 60s?
What if we downsize our home now instead of waiting?
Welcome to another episode of the What If Show, brought to you by Thomas Gold Solutions, the team behind Retirement Analyzer, the refreshingly simple software for financial advisors to use when developing and managing retirement plans for your clients. In this episode, Brooke and Steve are going to dive into life insurance as a core component of a client's financial plan. So let's get into it. Wonderful to see you, Brooke and Steve. What's going on with life insurance?
Welcome back, everybody.
All right, man. I'm really excited about this. Now, for the audience, just so you know, we're flexing our muscles today because we're kind of going a little off script. We decided right before this recording that the topic du jour is going to be life insurance and how important it is for the financial plan. So, Steve, I'm going to kick it to you first because, well, frankly, this was your idea to discuss life insurance and how important it is for the financial plan today. So, I guess let's level set things with, why is life insurance just important for somebody's retirement plan at a high level anyway, right? I mean, like, we always think of life insurance as this thing we're going to use when we're dead and our heirs get the benefit of. Why should somebody be thinking about life insurance as a core component of the retirement plan?
Yeah, it really, and thanks, Mike. Yeah, it really does affect, how the plan's going to turn out. There's all kinds of very, very neat features in life insurance. The thing I like the most is the multiplier effect. You could take funds from your accounts and actually purchase life insurance and have a death benefit that might be 4 or 5 or 6 times more than what you actually paid in. And the best part about that is it comes out tax free to your beneficiary. So is it part of the planning? It sure is. A lot of times if people want to leave a legacy, okay, a lot of people, there's still people out there, right, Brooke, that don't want to spend a dime so they can pass everything to their beneficiaries, And so what happens if you actually have to use that money during your lifetime? What do you do then? What if you're not giving your beneficiaries what you really want to? So what you can do is you can actually purchase life insurance, use up your assets, okay, and then have the death benefit for them, at the end of the day. So there's all kinds of cool things. I think what I'd like to do, if we could, Mike, a little bit, is touch on this negative connotation, why people just don't like to talk it. They shy away from that life insurance conversation.
I think that's a really important one. Brooke, I mean, we talked about this before we clicked the record button about, like, this is kind of one of those, I don't know, man, like, nobody likes to talk about this concept of, like, I'm going to die someday and how much money is going to be left over when I'm gone. And do you have enough and all that type of stuff. And by the way, making a monthly payment for this thing that I'm not going to use is also kind of, so, like, how do you work with advisors that got to get them to understand, like, this is a really important conversation to have?
I think we've all been in those client meetings where as soon as you say life insurance, it's like the hair on the back of the client's neck stands up. They just become clammy and tight. It's not a fun conversation to have. But I think one super cool thing, if you're using Retirement Analyzer and you're using it correctly, it can really help guide that conversation just kind of organically. You're going to look at a perfect world. It's raining gumdrops. Here's what your life looks like. You can pay your bills. You can maintain your lifestyle. And then we have this life insurance tab where an advisor can simply click there, and it's going to take all of the data that you've already entered, and it's going to look at, what happens if somebody passes away? What does that do to my income sources? Does Social Security go from 2 benefits down to 1? It's going to look at all of that for you, and then it's going to arrive at a what if. What if we wipe this person out and we do not have any coverage in place? And it pops up a big red line, and it will actually show the client, if you do nothing, here's what your situation is going to look like. And it really just helps create the why. And then you simply put the product in place to take care of the problem. And I think for me, at least, Steve, it really helped just, again, naturally create that conversation where you're not just slapping a life insurance illustration down on the table.
Exactly. I mean, and why is it so important? Just to add this too, you don't know what's going to happen. You have no idea what's going to happen tomorrow. You don't even have any idea what could happen toward the end of the day today. Who knows? But there's a chance you might not be here All right. Before you actually think, before everybody feels like they can live to a certain age or whatever. Right. But what if the unthinkable happens tomorrow? What's going to happen? See, basically, a retirement plan is a bunch of numbers with all kinds of moving parts all over the place. And if let's say we have a married filing joint type situation, and one spouse is actually subtracted very, very early out of that picture. I mean, the amount of shuffling of numbers is just amazing. Okay, when that happens. So that's where life insurance actually comes in and replaces what the deceased spouse would have brought to that relationship. And I think it's real important that way. So as a protection, I mean, I think there's all kinds of other things you can do with life
Yeah.
insurance, but as a protection, just basic, I think it's something you really have to consider because again, there's so much uncertainty in life, right? You just don't know.
Yeah. Well, what's just funny? It's like there's uncertainty, but there is certainty, right? Like two certainties when you're thinking about planning for your client's financial life. They will stop working at some point in time, right? So they are going to retire whether they choose to or the world chooses to for them, right? Like makes that decision for them. And then at some point in time, you are going to pass away or your spouse is going to pass away. There's going to be a death in here and it's going to end. So it's like, you're right. There's uncertainty. We don't know when. Like nobody knows when their last day is. Let's hope it's not the last day for me today. Like not good. But like, no, but I get it, right? Like it's really important to have this conversation.
Well, and I think one thing a lot of clients think is that when they retire, the need for life insurance goes away. And that really is not something, we typically see. When you, again, plug the numbers into RA, it's going to show you, does that need continue on? Sometimes in rare situations, it might actually even increase as people retire. Maybe they want to pick up a second home or they want to relocate, something out of the norm, and their life insurance need actually increases as a result of that. So again, putting the numbers to it is going to tell the story as well as the death benefit needed.
Just to add to that, Brooke, too, like when you have a good planning software like Retirement Analyzer, I mean, you can forecast certain things. So you really have to tell the analysis your story. Okay. In other words, how much do you want to have for your beneficiaries at the end? All right. How much do you spend today? What are we replacing? And we could, you can show with Retirement Analyzer a bunch of different scenarios where the death benefit needed actually fluctuates, sometimes by a lot, depending upon what you want to do. But as a replacement, for the unthinkable that might happen, I mean, it's an amazing tool. It's an amazing tool. And again, it's tax free too. Okay. So I think that's a big, big plus with life insurance.
One thing that's call this the elephant in the room question. And I bring these up a lot for conversations around advisors because we're talking about how advisors can better serve their clients, of course, but we also want them to have the advisor, his or herself, to have a vibrant business, right? And they're business people and they think about their bottom line. They think about their operational elements of their business. And I know some advisors are exclusively focused on stocks, bonds, and mutual funds as their primary things they sell and manage in their AUM agreement, right? So there's a lot of those advisors who don't also have an insurance license, who don't think, and so when a product is not part of their suite of products they offer their clients, sometimes they're like reluctant to talk about it because they don't feel overly informed about it or overly incentivized to talk about it, right? Because every dollar that's going into that life insurance plan is one that I'm not managing and one that I am not earning bips on, right? So talk about that, about how do you help advisors, or how should an advisor think about this as, hey, this will benefit you too in your, assuming they aren't an insurance licensed advisor.
Well, what I mean, basically, it actually makes the plan better. So if you don't sell life insurance, okay, but the concept is there really to replace. Let me give you a simple example. Let's say again you have a marital situation, a marital file, and one spouse actually passes unexpectedly. What happens to the assets? Okay, that it was stayed, under your management, if one spouse is gone. All right, one spouse isn't earning, one spouse isn't contributing. What happens to the assets under management? Okay, when you have one spouse, there's all kinds of tax ramifications and things like that. But I can promise you the assets that are left after the death are going to probably disappear faster than if both spouses were living. So you have to understand that. I mean, that's really a big deal when it comes to, I mean, assets that are supposedly or projected to be, this amount of value at the end of the plan. If they're upset early, and you guys know the compounding,
Yeah.
value of assets. If they're upset early, they don't grow sometimes they don't grow anywhere close to what you think they're going to grow to. So that's where the shock comes in on premature death. And that's what you have to plan for with this great thing called life insurance. And again, I have to go back to, it's tax free when you receive it. So, I mean, that's absolutely tremendous. That's held up for so long. It's just a beautiful thing. Great concept, really is.
Well, and I feel like too, if you're managing money and you have your 7 or your 65 or something like that, I would encourage you to look at getting a life insurance license. I mean, that should be a piece of cake compared to those other exams, because this is such a natural way to go back to your existing book and really just start looking at life insurance with those people. I mean, you could really create a whole new revenue stream just by doing that. We've had a lot of advisors come back to us and say just that. I went back, started running the numbers, it created the need, and then I'm simply putting, again, the product in place to take care of it.
Yeah. That's it.
Let me just add this too, Mike. I mean, what do businesses do? You were just talking about business a little while ago. What do? Let's say you have 3 partners. What do? It's their responsibility to do what? It's a buy-sell agreement with life insurance, right? Why? If one of them passes away, okay, everything's up in the air. All right. It's really a direction on what the other 2 partners will do. Maybe the life insurance buys the deceased partner out, pays the deceased partner's family, and then the other 2 can go on running the company. There's all kinds of great things you can do here with life insurance as a protection. And I think it has to be looked at. If businesses do that to protect the business, why wouldn't you do that to protect your family? And it's the same kind of deal, really.
It's really interesting. We had a prep call for another episode of the show yesterday, and you mentioned something that like all of us on that prep call started going, oh, wow, that's really smart to think about. You're talking about how like oftentimes if you were an heir, like if you have elderly parents and they're getting up in age and you're talking to them about their finances, sometimes they might be like, hey, I'm going to stop paying this life insurance bill because it's expensive and I don't need it anymore. I've got plenty of money saved up and this will be yours, Steve, someday. So there you go. But it might make sense for that heir to continue paying the life insurance premium. So I wonder if you can walk through that.
It's kind of crazy, right? Because I got to say, no matter what, this is what happens. Okay. When your parents become 80, the kids become your business partners. That's just the way it is, right? They want to know what they're getting. Okay. I mean, they love you. Don't get me wrong. They love you, but they want to know what they're getting. Okay. So just think about this for a second. If mom and dad have a certain amount of money at age 80, okay, and they live, I'm not going to say too long because that would be mean, right? But if they live to 90 or 95 or 100, I promise you this, right? And I've seen too many situations like this. The kids are wondering where their inheritance is going as the years go by. Okay. So now let's talk about what you asked, Mike. So now you have this life insurance that they have, and maybe they needed it when they were younger. Okay. That's great. They don't think they need it now, but given the situation I just gave you, as a kid, as a beneficiary, I think I might consider keeping that, mom and dad, no, you're not letting this thing lapse. You will not. We will actually take it over and you don't have to tell them why, whatever. But basically, that's really the way they should be thinking, because their dollars are actually leaving where you can actually conserve them through a life insurance policy that becomes payable, upon death. So, yeah. I mean, that's one of the kids actually, a lot of the times will say, mom and dad, don't stop paying that. We will pay it for you. Maybe we convert it. Maybe it's a term policy. I don't know. But they keep it going. And then when something were to happen to their parents, that they receive the death benefit. So if you can get through how it might be weird for some people to pay their parents' life insurance policy, as a financial instrument, though, if you run the numbers and look at that with the benefit coming in tax-free, I think it's a way to conserve life insurance policies. And for the advisors that are listening here, that's a nice setup for you, converting a term into a permanent policy that the kids might pay. Yeah.
Well, and even if they don't need the life insurance coverage per se, there's always a cost to die. And I hate to say it like that, but the funeral cost is a factor. I mean, in this day and age, you've got the funeral cost, obviously whether they're going to be cremated versus buried changes the price a bit, but your average funeral is 20 plus grand typically. So that's always something people need to factor in as well. In fact, we've got a really great fact sheet in Retirement Analyzer right in our locker that we title it the funeral costs by state, that really breaks it down. Oh, wow. So you guys can have a fighting chance of seeing, what the average is in your area.
Well, I know it's really interesting you bring that up, Brooke, because that's the funeral cost, but there's a lot of, sad to say it, pre-funeral costs sometimes, you know what I mean? Absolutely. Hospice and other long-term, maybe short-term care situations that happens to somebody as they're getting towards the end of stage of life. And if they hadn't planned for that appropriately, that might be coming out of pocket or chewing up other assets while they're still alive. And then when they're gone, that life insurance policy could help you recoup that spending, right?
Oh, it's huge. And I think how many times, with things being so expensive, I was actually just dealing with a family recently on this, but the plan isn't in place and the money isn't there. So now they're trying to move elderly parents into their home to be able to take care of them because the costs are so outrageous. And then it completely disrupts their life. I know Steve's been through this with both of his parents as well, but being a caretaker is not easy. And it's so expensive to have those outside sources come in to provide that care. So it's definitely something, I know that shifts a little bit more, the long-term care side of things, but sure. Also just the planning, I think, is critical.
But Brooke, Mike, let me say this too, though. And so look at the last year before the death. And Brooke, you and I have done some study and research on this. The costs of somebody dying is not just the funeral. I mean, maybe you said this, Brooke, I don't know, but not just the funeral. Okay. And then, the plot and everything else. It could be that last year, before you pass. And again, that's when costs just could explode. They could. And so again, just like Mike said, this death benefit actually replaces that.
Yeah.
Okay, it replaces that, and it's really an amazing concept. Life insurance really is. Yep.
Well, in this day and age, Steve, I don't know if we want to talk a little bit about products like that Equitrust Bridge product or something similar to that, where the combo products really can kind of take care of both sides of it.
You can. You there are products too where you can actually use the death benefit while you're alive for long-term care if you qualify for that. Okay, so you could do that kind of stuff. There's all kinds of things you could do. And we could spend the next 20, 30 minutes just talking about the uses of life insurance. People don't know about this kind of stuff. Yeah.
Well, let's dive into it. I mean, it's funny as we're talking about this type of stuff, and I can't help but think both of you kind of have like these Western inspired type background. So well, yours is a bull versus a bear, but it makes me think of this.
I have a Western inspired background.
It looks like it with a bull. The bull makes me think.
Yes, I was noticing right as we click play, we both have bulls in the background for two very different reasons, folks. But yes,
and I can't help it. Like and I know you're in the Arizona area now, so you're not living on the ranch, Brooke. But I can't help but think you just got back from some of this rodeo competition stuff like that. So I think about it, and then of course yesterday I'm listening to a podcast with Taylor Sheridan being interviewed, and I'm like, okay, so now I'm like totally in ranch mode. But one of the things that pops into my mind as we start thinking about life insurance is one use case that I'm sure you guys have explored is keeping the family ranch in the family type of concept. Like, I don't have a ranch. I don't come from a ranching family, but we have a small cottage. My parents have a small cottage on Cape Cod. It's not like a palatial estate or whatever. It's a small cottage. It's meant to be there for the summer, and it's not really meant to be stayed in the winter, all that type of stuff. But like parents want to pass that stuff along to their kids. Like the next generation gets to use the ranch, the cottage, the whatever. Well, estate taxes can be pretty onerous, let's say, when it comes due, right? They can be pretty steep, and it can really kind of negatively affect the ability for a family to keep, a family piece of real estate in the family. So, have you seen this use case, and like, what's the appropriate way to think about that?
I'm going to use my own family as a prime example. I was born and raised on a cattle ranch in Washington State. There's my sister and I, and you are facing something with that particular group of people. They're typically really asset rich, but cash flow poor. And so, that makes it difficult when you're transferring and when people are passing to pay the taxes for that. So Washington State is a great state that not only do, their taxes are out of hand. They just tax everything to death, but they also have a state inheritance tax. So that was a big factor for my family in, again, planning for that next generation. So you can set up trust, you can set up all of these things, but we went in and put the life insurance in play to help create and take care of being able to pay those taxes and, again, transfer the wealth to the next generation. And it really, thankfully, we aren't there yet. Nobody's passed away yet, but it will be a smooth transition when that time takes place.
And just being through this, I've been through it before. It takes the pressure off trying to settle the estate. If you're the executrix, and you're going through this, I mean, Brooke, I think estate tax, you can tell me if I'm wrong. I think last time I looked, they're due 9 months after death. So you got these people that are going along, okay, and then all of a sudden it's a substantial piece of property. Okay, and the estate taxes are due. And Brooke said, they're cash poor. What are they going to do? They can't pay the estate tax. So a lot of times life insurance is put into play. Okay. Death happens. It's paid out. Use that to pay the estate tax. And it's timed perfectly to do that. Okay. So larger estates, they could owe millions of dollars. You know what people do? And we haven't even really talked too much about this, but there's people that actually buy large insurance policies, large ones, if they have an estate tax bill of $10 million. $8 million, $5 million. Maybe their estate's worth, I don't know, 40 or 50 million, whatever. But they take, I think the concept's the same. They take the proceeds of the death benefit and they use it to pay the estate tax. And then they keep the estate, kind of intact, basically. And so that's what it's used for. Yeah.
I love it. So what are some of the other, like, what you would say is the core use cases of life insurance that the average person's probably not thinking about?
Okay.
You're me.
I'll go first. Okay.
I love it.
I think one thing, when people are young and they're healthy and they're working and maybe they've not yet established a family or they think, what, I don't need life insurance. Steve, you want to talk about how we can combat that or really create a need for that or show the need for that, I should say?
Well, we can in the software program, we can actually do that. So what we can do really easily, and your software, if you're using another, planning software, whatever, should be able to do this. You should be able to subtract one spouse out of the equation and see what happens. It's really that simple. You could show death, let's say this year. You could show death 20 years from now. You could see what the death benefit need is this year versus 20 years from now. And you could really get that into it and to show what, your client needs. Needs analysis, that kind of stuff. I think they still use that. But this one here actually has all the moving parts inside the plan. Some of them are stopped because the person's not there anymore. And it shows the effect on the survivor. It does. And it does a real good job of that. So you can show that with two clients sitting at your desk or, in front of their computer. And you could show and say, look, what do you want to protect? How much do you want to build this to? And we can use life insurance for that. But I think one of my favorite ones is that people don't know about is this be your own bank concept. I think this is absolutely terrific. So let me kind of explain it a little bit, Mike, if that's okay. We'll go with that here a little bit now. All right. Here's what you do. You actually buy a life insurance policy. Okay. And this is a permanent policy. Okay. And you pay a certain amount for the premium. Okay, so we'll keep it real simple. You pay a premium, you get the death benefit. What if I can actually pay a little bit more than the premium or more than the premium, and have the excess, go into an account that I might have access to tax free if I want that. Okay, so let's throw some numbers in there. Okay, I pay $1,000 a month, $12,000 a year, and I have $400,000 of life insurance. Okay, I want to pay more than $1,000 a month. Okay, maybe I want to pay $2,000 a month. The extra 1,000 actually goes into an account, okay, and can be affected by insurance company performance or whatever. But you can actually have that tied to an index, just like an annuity might be, and that can actually grow. That extra 1,000 over and above the premium amount can grow. And then all of a sudden, and we call that cash value inside the life insurance policy. Okay. And so it can grow to a substantial amount of money. Now, what do you do if you buy a car? You take a loan from a bank a lot of times. Okay. Or you take a loan from somebody else. What if you could actually access that cash? Okay. Let's say let's fast forward a little bit, and 10 years into it, let's say the cash value now is 200,000. Now, I can go in and I can take 20,000 out, 30,000 out, 40,000 out, tax-free, to pay whatever I want to pay. I want to buy a car. I could do that. I can even pay that back with interest into the policy. So what have you really done here, though? Okay, so basically, and if you pay it back and the thing keeps building and you do it over generation after generation after generation, what do you have there? Don't you have the family bank? So it comes from overfunding. In other words, paying more than the premium, and then let that cash, that extra, start to grow into something that's accessible tax-free. And again, if you have people who are going to, run this thing the right way, and it'll be passed on from generation to generation, you pay it back. You don't just take money out of the cash flow, you pay it back. So you can become the bank. And maybe you charge a small interest rate or something like that, and then they can pay that money back into the policy. And again, the policy explodes into something really nice. Down the road, you wouldn't have to go to a bank anymore and get gouged with, loan interest rates on, on car loans or something like that. You just go to the family bank. And Mike, I think a lot of people don't know that. I think it's a great concept, though. That you should look into,
Yeah.
Let's just recap it really quick. So that is a Nelson Nash concept, right? So really two primary things out of it. You're either going to pay the interest to somebody else, or you're going to basically use your money and keep that interest. I think to summarize it, Steve, is basically the gist of it.
Yeah. You can put the money back in the policy whenever you want to, right? I mean, now here's the deal with this, though. You can't go nuts. Okay, there's certain regulations. You can't say, hey, look, I'm going to have $1,000 a month for my insurance, and I'm going to put $50,000 a month into this thing that can grow and I can have it tax-free. No. There are rules and regulations with death benefit and things like that. So you have to run the policy through these rules, and it will tell you the largest amount, the limit that you can contribute over and above the premium payment. And then you can have this bank started. And I think over the years, Brooke, I think that if you do this, right? I mean, I think families would be in great shape generation to generation using the multiplier effect of life insurance and this cash value to borrow from. It'd be an amazing thing. So I think that's one of the big uses that isn't talked about enough, I think, Mike, is that.
Well, and especially in today's environment where, your interest rates are just outrageous. I mean, a home loan right now, I haven't looked here recently, but are they still around 6-7%?
Yeah.
Yeah. I mean, I bet your car loans are 8 or 9%.
They're 8, yeah.
Really, really high interest rate environment right now. So it's a great concept to look at.
This raises an interesting question, and I think it's related. It's related to the earlier question I asked about the uncomfortable nature of talking to somebody about, hey, at some point in time, you're going to die. Let's talk about this. Let's talk about putting money in there. There's also an interesting conversation that has to happen between the advisor and the client, which is, hey, look, these may seem like kind of no fun things to do and set up when you're younger, and pay more into your life insurance policy and let it accumulate versus spending that extra money and doing the things you want to do. They may feel like no fun stuff, but I'm here to convince you that this approach, you'll really appreciate it 20 years from now, right? Type of stuff. How do you, as an advisor, like what is the best way to make sure you have that type of conversation and relationship with your client, right? Because, a lot of clients probably don't want to be told, hey, here's the kind of conservative approach that'll have big, awesome benefits later.
Well, I think you have to have the deep conversation with them. Okay. And the good thing about using, a program like RA, Retirement Analyzer, you can sit there and say to the client, what do we want to build your plan to have left in it? What do we want to build to? Okay. And what we're going to do is we're going to use life insurance at the end to build to that number. So when you're sitting with an advisor, I don't know how many clients say, look, you know what? I want to make sure that I can spend all the money I can when I'm alive. I don't want to be crimped. Okay. But on top of that, I want to make sure I leave $1 million because I have 2 sons and I want them each to have 500,000 if I'm not here anymore. So that kind of, you use life insurance to hit that number if both spouses make it to age 100. If they don't, then it's even higher. But on the the lowest level, the number that they didn't want to go below, $1 million, okay, it won't go. We can plan to have enough insurance in place to never go below that number. And it's really just like a legacy play then, right? Well, what do you want to leave? And so that you get into that conversation, it's rather deep. It's almost like, to me, it's as important as filling your, well, maybe not as important, but as filling a will out, powers of attorney out, trusts. You have to, it's your responsibility to yourself to do that. Your client, they should do that. You have to convey that to them. If not, anything can happen and the whole thing can just fall apart. And that's really what you have to have, that kind of deep conversation with a client. But I think asking them, what do you want to build to? I think will open the door for that.
Yeah. That's really, really important. We don't have much more time left together in this episode, but I did want to tackle one thing that I think is worth at least acknowledging when it comes to life insurance. 20% of adults are child free, right? Like, so they have no direct descendant heirs. And then there's another percentage of humans out there that are willfully solo. They're, you know what I mean? Like, so they not married or whatever. How important is it still for those folks to have life insurance?
Well, nieces, nephews, charities. I mean, we've seen it all. Like, I mean, it's important for people to give, and it might not be till the end, but they want to give, and there's always somebody to give to. There is. Every once in a while, Brooke and I will come across a client file that we're looking at where they're not related to anything or anybody.
Yeah.
Okay.
Yeah.
Once in a lifetime, and they don't like charities and they hate people and they whatever, right? Yeah. But for the most part, I think there's something there. One thing I'll tell you, Mike, is this. It's very funny, Brooke. We go through this all the time. The one person they don't want to give it to, or the one entity, is the government.
Yeah.
So they will do anything to not pay the government, or they want to give it to somebody. And I think that you'll find that with most people. Yeah.
I love it.
Well, and just some fun facts. The average will, they say, is reviewed once every 19 years. Mike, you touched on this a moment ago, when in fact, I think your typical attorney says you should be reviewing it, around every 5 years. So think about that. Once every 19 years. I mean, how many times are there ex-spouses or, people that they're not really intending to get the assets that they just forgot about or overlooked it? I mean, Steve and I see that all the time. So we have trackers and beneficiary reviews with our clients to just make sure that it's really set up the way they want it to be.
I love it. That's really important. It is funny because there's a lot of set it and forget it that happens in your brain, right? You didn't decide to adjust your beneficiaries. And it's like, the fact, I'm sure lots of ex-spouses are still beneficiaries on RIAs and IRAs, and other types of deals. Okay.
Mike, let me just add one thing though too. And then there's also the spouse that's in total shock when the one spouse dies and he or she doesn't get what he was supposed to, and it went to a kid from a first marriage.
Yeah.
Or the
all kinds of craziness, right?
Yeah, right. Yeah. It's crazy. Yeah. So take care of your paperwork, people. So, but you're doing your clients a service of every time you see them going, okay, let's go through things. Like, when was the last time you looked through the will? When was the last time you reviewed your insurance and all that type of stuff?
Yeah.
Going through, having a checklist of here are some use cases, common use cases. Here's some that might apply to you, right? Pretty simple conversation to have. Okay. Now it is time for everybody's favorite segment, Retirement BS with Brooke and Steve. Today's topic is, after a certain age, life insurance becomes less important to your financial plan. Brooke, what do you say? BS or good to go on that one?
It just depends. So I'm going to say BS to that because, again, and I alluded to this earlier in the conversation, but it just depends on what the people are wanting to do later in life. I mean, yes, your typical life insurance curve is going to start out higher when they're younger, and you're going to see it drop as they get older. But if they're going to sell a home, relocate, maybe they decide they want to travel more, who knows what the situation may be. But you can see that actually go up again, depending on their life choices. So I'm calling BS on that one, Mr. Goldstein.
I'm calling BS also. I am. It all depends on this, though, doesn't it? Right? If you're trying to land, and this is we get this sometimes, your clients, and at age 100, you want to land at like $1 left in your plan.
Yeah.
Okay. So you can drop the life insurance, and we'll kind of forecast that out for you. But what happens if you have your heart set on leaving something for the kids and stuff? No. It's important and it has to stay there. That's why we have these kids offering to pay the premiums on this. It becomes more important as you get older because we have no idea. I mean, I hate that this is going to be bad, Brooke. How long people linger? Is that bad? Yeah. That's bad. I mean, I don't mean it like negatively.
No, but it's true.
People live longer than you think, though, right? So you can't come up with that number. It's up in the air. So I'd say
people will surprise you how long they're cheating death. They will just be like, you know what? Not today, brother. I've got another one coming. Well, this has been a fantastic conversation. If you've been enjoying this conversation, we'd love to hear from you. Shoot us a note. Let us know what some of your most interesting life insurance use cases you've come across for your clients. Be really interesting to hear from you. Maybe we'll cover it in a future episode. Now, as I mentioned at the end of every episode, please do make sure you subscribe to the What If Show on your favorite podcast platform. We're on Apple Podcasts, Spotify, Amazon, the YouTubes, or wherever you like to get your podcast jam on. We are happy to have you with us. Okay. Well, this was fantastic. Brooke Thomas, Steve Goldstein, thank you very much for making my job easier.
You make us smooth, Mike. You really do. Thank you for being you. Yeah.
Thanks, guys.